This story begins with a company that thousands of people once trusted with their savings. Rosalind Capital, a well-known dealer in gold and silver, has now filed for bankruptcy in federal court. And behind that filing is a number that is hard to ignore. More than 600 customers are owed $60 million worth of gold and silver they may never receive. For years, this company built a name for itself through heavy advertising. Its ads appeared often, especially during periods when gold and silver prices were climbing. People saw those ads, felt confident, and decided to invest. Many of them paid the company up front, trusting that their metal would either be delivered quickly or held safely until it was ready to ship. But according to the bankruptcy filing, that is not what happened. Court documents state plainly that the company held no remaining metal inventory. In simple terms, when customers came looking for the gold and silver they had already paid for, there was nothing left to give them. So how did a company reach this point? The filing points to a business practice that many customers were likely unaware of. When people placed orders, the company did not always already own the metal needed to fulfill them. Instead, it accepted the customer's payment first and only afterward went looking to buy the actual gold or silver from other sources. In a calm, steady market, this approach might have caused only minor delays, but the market was anything but calm. Toward the end of 2025 and into early 2026, gold and silver prices rose sharply. Every day that passed without the company sourcing the metal meant it would likely cost more to buy later. This created a serious and growing gap between what customers had already paid and what it would actually cost the company to deliver. At the same time, the filing reveals another detail that made the situation worse. Sales representatives were reportedly paid commissions of between 15 and 35%, and importantly, these commissions were paid out immediately after a sale, even if that order was later canceled or never completed. This meant that money was leaving the company right away, while the responsibility of actually finding and delivering the metal came afterward. Analysts studying the filing describe this as a business model problem, not simply bad luck caused by rising prices. A company that already holds physical inventory before selling it does not usually suffer when prices go up. In fact, rising prices normally help such a business, since it can sell metal it already owns at a higher price than it originally paid. Rosalind Capital, however, was selling promises rather than physical metal, and those promises became far more expensive to keep as the market moved. The early consequences of this gap became visible in the numbers themselves. The filing shows the company owed customers nearly $49 million from orders that were paid for, but never delivered. On top of that, another $11.8 million was owed to customers who had sent in their own gold and silver to sell back to the company, but were never paid for it. Together, these figures explain how the total debt to customers climbed past $60 million. For the people affected, this was not just a number on a page. Many were ordinary investors who believed they were making a safe, traditional investment in physical metal, something many people choose specifically because they see it as more secure than paper investments. Instead, they found themselves waiting months for deliveries that never arrived, watching a trusted name collapse under debts it could not repay. This is where the story truly begins. A company built on advertising and promises, unable to keep pace with the very market it depended on to succeed. To understand how something like this is even allowed to happen, it helps to look at the rules that are supposed to protect customers when they buy gold and silver. In the United States, precious metals dealers are not regulated the same way banks or stockbrokers are. There is no single federal agency that watches over every gold and silver dealer the way the Securities and Exchange Commission watches over stock trading. Instead, oversight is scattered across state consumer protection laws, general business regulations, and in cases like this one, bankruptcy court. This gap in oversight matters here. When a customer pays a dealer for gold or silver that has not yet been delivered, that customer is not treated the same way a bank depositor is treated. A bank deposit is typically insured. A prepaid metals order is not. Once the money is handed over, the customer becomes what is legally called an unsecured creditor. That means if the company runs out of money, the customer stands in line with everyone else the company owes money to, hoping there is something left to collect. The bankruptcy filing itself lays out this exact situation in plain language. It states clearly that Rosalind Capital holds no remaining metal inventory. This single sentence carries enormous weight because it confirms that the company simply does not have the physical gold and silver needed to pay back what customers are owed. There is nothing sitting in a vault waiting to be shipped out. So what does the company have left? According to the filing, its total remaining assets are valued between $1 and $10 million, a small fraction of the $60 million owed. And among those limited assets, one stands out. The filing describes the company's customer database as one of its main remaining assets, referred to formally as the customer information asset. Court documents indicate this asset is expected to be sold through a court-supervised auction, meaning the personal information of customers who are already owed money could be purchased by another company entirely. This detail has drawn attention because it highlights a difficult reality of bankruptcy law. Courts are focused on recovering whatever value remains to pay off creditors. And customer data, unfortunately, can hold real value to buyers, such as marketing firms or other dealers. For customers who already lost money on undelivered metal, learning that their personal information may now be sold as well adds another layer of concern. The filing also details how sales commissions were structured, and this detail is now being looked at closely as part of understanding what went wrong. Representatives reportedly received between 15 and 35% of a sale as commission, and this was paid out immediately once a customer's payment cleared, even in cases where the order was later canceled or never fulfilled. This meant that a large portion of customer payments left the company before any metal was ever sourced or delivered. At the same time, the filing references other outstanding debts connected to the company's rapid marketing push. It states that roughly $1.9 million was owed to a major television network for advertising that had already aired. This detail helps explain how the company maintained such a visible presence even as its financial foundation was weakening behind the scenes. As of now, the case remains active in federal bankruptcy court. No timeline has been confirmed for when or if affected customers will recover any portion of what they are owed. The auction of the company's remaining assets, including the customer database, is expected to move forward as part of the standard bankruptcy process, with proceeds distributed according to legal priority among creditors. For now, the picture that emerges from official court documents is clear and troubling. A company that took in tens of millions of dollars from trusting customers, spent heavily on advertising and commissions, and is now left with almost nothing to give back, except, notably, the very customer records that could be used to reach new buyers in the future. The collapse of Roslyn Capital reaches far beyond the company itself. It touches real families, an entire industry built on trust, and a broader conversation about how everyday people protect their savings. Understanding these consequences helps explain why this story matters to far more people than just the 600 customers directly named in the filing. For the individuals affected, the financial loss is significant. Court records suggest the average customer is owed well over $100,000 in gold, silver, or unpaid funds. For many, this was not extra money set aside for speculation. It was retirement savings, inheritance, or money set aside specifically because precious metals are often seen as a safer, more stable choice than stocks or paper currency. Losing access to that money, possibly permanently, can affect a person's financial security for years to come. Beyond the individual level, this case raises serious questions about trust within the precious metals industry as a whole. Millions of people choose to invest in gold and silver specifically because they view physical metal as dependable and immune to the kind of collapse seen with some financial companies. When a well-advertised, seemingly established dealer fails in this way, it can shake that confidence, not just in the company involved, but in the broader idea of prepaying for physical assets from any dealer. Industry analysts studying this case note that reputable, well-run dealers typically hold inventory before selling it, which protects both the company and its customers. This case is now being used as a teaching example of what happens when that basic safeguard is missing. Other dealers, eager to reassure their own customers, may find themselves needing to explain their inventory practices more clearly and rebuild public confidence that was shaken by this collapse. There are also economic implications tied to the timing of this failure. It happened during a period of historic strength in gold and silver prices, a time when public interest in precious metals investing was especially high. New investors, drawn in by rising prices and heavy advertising, may now approach the market with more hesitation. This could slow enthusiasm across the industry, even for dealers who operate honestly and responsibly. There is also a quieter but equally important consequence tied to the sale of the company's customer database. For the people whose information may be sold to another buyer, this adds a layer of vulnerability beyond the financial loss they have already experienced. Consumer advocates have long warned that a company in financial distress may treat customer data as one of its few remaining valuable assets. And this case illustrates that concern clearly. Affected customers may find themselves targeted by future marketing efforts, or in worse cases, by parties looking to take advantage of people already dealing with a loss. It is worth noting that perspectives on this case differ depending on who is asked. Some industry defenders argue that rising prices created an unusually difficult environment for any dealer working with limited hedging strategies, and that this situation reflects poor risk management more than intentional wrongdoing. Others, including consumer protection advocates, argue that the company's sales practices, particularly paying full commissions immediately, regardless of whether an order was fulfilled, created an environment where sales were prioritized over responsible business practices. Both viewpoints are represented in ongoing public discussion, and the court process itself will ultimately determine how responsibility is assigned. What remains clear, regardless of perspective, is that this case highlights a gap between how confident customers felt and how protected they actually were. For an industry built heavily on public trust, that gap carries consequences that extend well past this one company. shaping how future customers evaluate where and how they choose to invest their money. By now, the full picture of this story has come into view. A company built on strong advertising and customer trust ultimately failed to deliver on the very promise that brought people to it in the first place. As this case moves forward, several important questions remain unanswered, and viewers are encouraged to think carefully about what this story means for their own financial decisions. One question worth considering is this: how much do people really know about the companies they trust with their money? Many customers likely assumed that a well-advertised, established dealer automatically held the metal it was selling. This case shows that assumption is not always accurate, and it raises a broader question for anyone considering a similar purchase in the future. Before sending payment to any dealer, it may be worth asking directly whether the metal is already in stock or whether it will be sourced only after payment is received. Looking ahead, the bankruptcy case is expected to continue moving through federal court in the coming months. As part of this process, the company's remaining assets, including the customer database, are expected to be sold through a court-supervised auction. Creditors, including the affected customers, will be paid according to legal priority, though it remains uncertain how much, if anything, individual customers will ultimately recover. Court filings related to asset sales and creditor claims are typically made public, and interested viewers can often follow updates through federal bankruptcy court records or reputable financial news outlets covering the case. For those wondering how to protect themselves going forward, there are a few simple, practical steps worth remembering. Physical possession remains the clearest form of protection when it comes to precious metals. Whenever possible, confirming that a dealer already holds inventory before making a purchase can reduce risk significantly. It is also reasonable to ask a dealer directly about delivery timelines, and to treat unusually long shipping windows as a signal to ask more questions. Researching a company's history, reading independent reviews, and avoiding pressure to invest quickly, especially during periods of rapid price increases, can also help people make more informed decisions. This story also serves as a reminder that rising prices and heavy advertising do not automatically mean a company is financially sound. In fact, as seen in this case, rapid growth without proper inventory management can sometimes increase risk rather than reduce it. Understanding this distinction may help viewers evaluate similar opportunities more carefully in the future. As this case continues, Golden Crest Finance will continue following developments and bringing verified updates as they become available. Viewers are encouraged to share their own thoughts on this story in the comments. Have any viewers had experience with prepaid metal orders, either positive or negative? What questions do people think dealers should be required to answer before accepting payment? Conversations like these help build a more informed community, and every perspective adds value to the discussion. In the end, this story is about far more than one company's downfall. It is a reminder that trust, once placed, carries responsibility on both sides. The responsibility of a company to honor its promises, and the responsibility of customers to ask careful questions before handing over their hard-earned money. As this case moves through the courts in the months ahead, its outcome may shape how the broader precious metals industry operates, and how future customers choose to protect themselves. Thank you for following this story with Golden Crest Finance. Stay informed, stay careful, and continue making decisions with confidence and clarity.